Welcome to New Direction Trust's educational video on required minimum distributions. Today we're going to go over some very common questions surrounding required minimum distributions. We're going to take a look at the times when these distributions are required from qualified retirement plans. And before we jump in too heavily, just want to confirm that this video is intended for educational purposes. We're certainly going to cover some of the basic rules around required minimum distributions, but we would always suggest that you consult a trusted tax advisor. So that could be a CPA, whomever files your tax return, or if you have a financial advisor. So before making any final decisions, we always encourage you to take the information you're getting here and run it by someone that you trust when it comes to decisions around these required distributions. So what is a required minimum distribution? And just so you know, moving forward, anytime you see the letters RMD, that's just short for required minimum distribution. So this is the amount of money that the IRS requires someone to withdraw from a qualified retirement plan. So it could be an employer-sponsored retirement plan like a 401k, a 403b, or a thrift savings plan. It also applies to most tax-deferred IRA plans. And so traditional IRA, SEP IRA, or simple IRAs that are tax deferred will be subject to these required distributions. Now, it's important to note that Roth type retirement plans, so it could be a Roth IRA, could be a Roth 401k, it's even possible to have Roth simple and Roth SEP IRAs. Beginning in 2024, they are not subject to required minimum distributions. And that applies to the original owner of that Roth account as well as potentially the spouse. And that's if the spouse inherits that Roth account and they choose to inherit it as their own. So let's talk about what RMDs are not. So these are not voluntary distributions. So what do I mean by that? The IRS is very aware of the amount of money that any taxpayer has in retirement accounts. Every year, custodians report those amounts to the IRS, and obviously the IRS knows your age or if you have an inherited account. And so when you reach a specific age, which we'll get to in just a bit, we'll discover that the IRS is very much expecting those distributions. And if you don't make them, of course, there could be a penalty involved. So RMDs are not distributions that are taken prior to what we call required minimum distribution age. These are, think of them as forced distributions by the IRS. So there are two times when required minimum distributions occur. The first is when the account owner reaches a specific age. They must begin taking these distributions. Or the other time is if an individual inherits a retirement plan, and we'll go into more detail on both of those. So let's start with the age at which required minimum distributions begin, and we're going to just focus on a recent update to the law, recent changes. And so individuals born between 1951 and 1959, their RMDs begin in the year they turn 73. If somebody's born in 1960 or later, those distributions are going to start when they turn age 75. So what is the deadline for these RMDs? In the first year that you turn RMD age, the IRS gives you a little bit of extra time. So they allow you to take that first required distribution up until April 1st of the year following either your 73rd birthday or 75th birthday, depending on when you were born. This is for the first required distribution only. So be careful here. The taxable event, meaning the taxes that you'll be required to pay, they happen in the year that you take the distribution. So let's take a quick example. This is why I would say be careful. Let's say that in 2024, you churned 73 and you are required to take a distribution, but you wait until, let's say, January of 2025. Because you were taking the distribution in January of 2025, that means the taxes apply to the tax year 2025. Here's where it could be a little bit interesting, is that in the next year, the second year of your required minimum distribution, the deadline is the end of the year. It's December 31st. So you would actually be taking 2 distributions in 2025 to meet this requirement. So you just want to be careful or be prepared that if you do wait in that first year and do it in the following year, take that distribution before April 1st, you might end up with, probably most likely end up with 2 taxable events. So just be aware of that. So let's talk a little bit about some of the resources that we offer, but some other resources that you might want to be aware of. So we have a page on our website, and if you type in our website, ndtco.com, and then type /required minimum distributions, here's what you will see. This page actually has a lot of information. A lot of what we're covering today you can find it here on this website. And so I just kind of scroll down and give you an idea of some of the things that you'll find here. One of the things that's very important for our New Direction clients is to understand that we have a form, a distribution form, and in order for a distribution to count in a specific tax year, we have to receive the distribution request prior to December 31st. So the actual distribution might not actually happen until the following year. So let's just say, for example, you submit your distribution form at 11:59 p.m. on December 31st. The fact that we've received it means that you're okay, that we're not going to count that distribution for the following tax year. So you might not actually have the money taken out in that tax year, but because we received it prior to the end of the year, it will count for that tax year. Now, if you do a distribution request on January 1st of, let's just say, the following year, that's when the taxable event will happen. We're going to take a look at the distribution form in a little bit, but just wanted to make you aware of that. And so this kind of shows some of what we've already talked about. Do you need to take a required distribution? And here it talks about the ages at which distributions need to happen. And this is a pretty handy tool, something I wanted to kind of pop in and show you. How much do I need to withdraw? And so we have what right here, the RMD calculator, and we'll take a quick look at that. And this calculator, it actually takes you to another site, but basically you're going to enter some of the basic data and information, and it will calculate the required minimum distribution. So one of the things that I think is important to note is that the calculator is only as good as the information that you put into it. So my strong suggestion is don't rely on this calculator as your only source of information, and let me give you some examples and some reasons why that might be. We're going to be talking about this in a little bit, but you may have multiple retirement accounts. And sometimes you don't even know that you have a retirement account. So for example, you might have an old 401k that's from an old job and you forgot about it. Believe it or not, the IRS knows about that account. And so when you're inputting information, you may not have all the information at your disposal. You may not congregate or put all the different retirement accounts together and put their balances into the calculator. And so just keep in mind that the calculator works if you have all the balances and all the required information, but my suggestion is have somebody else double check what you're doing, your CPA, a tax advisor, just to make sure that the number you arrive at is accurate. So going back to our required minimum distribution page, this really just talks about the different types of distributions. We're going to be talking about that in a little bit, but you can see this is a lot of information here, and it's a great resource. And so again, ndtco.com/required minimum distributions. Okay. So let's jump back in, and then the question becomes, well, how do I take a distribution when it's required? And because New Direction Trust offers some unique types of investment opportunity or assets, there's a couple of ways that these distributions can happen. The easy one is what we call a cash distribution. And so that means you've got cash in the account that you're taking out to satisfy that distribution, or you're selling something. You're liquidating an asset so that you have cash available. This is what I think most people are familiar with. Very straightforward. But our clients own assets that are maybe not easily liquidated, or maybe clients are not interested in liquidating. They'd rather own the asset than sell the asset. So a couple of examples that are real common are real estate and precious metals. So you can do what's called an in-kind distribution. What in-kind means is that you're not selling off the asset. You're actually taking ownership of the asset, taking it out of the IRA and into your personal name, so to speak. So as an example, if you own precious metals, you can actually have the precious metals shipped to you. You take possession of the metals. That effectively takes the metals out of the IRA, and you now own those personally. So how do I take a required minimum distribution? What does that actual form look like? And so we're going to jump to the New Direction Trust website, and we're going to log in as if we're a client. And the actual distribution form is a DocuSign form, and we're going to take a look at that DocuSign form here in a bit. But when you log into your account may not look exactly like this, but you can kind of get an idea. But over here on the left hand side under Overview, we scroll down towards the bottom, and there's a link there that says Distributions, aptly named. And you're going to click where it says Distribution and Notice of Withholding, or Start Your Distribution. And what this is going to do, we're going to verify your identity, and ultimately you're going to get to a DocuSign form. So that actual DocuSign form is going to look like this. So we're just going to collect some basic information from you: your name, your account number, your social security number, and then section 2, you can see there's quite a few options when it comes to what type of distribution is this. Now you'll notice the very first one listed here is required minimum distribution, so you would select that type. There's a little bit of information here kind of explaining the different kinds of distributions that might come up. And then when we skip down here to section 3, you'll notice that we're going to ask you, well, what kind of distribution is this? Is this a cash distribution only? Is this an in-kind distribution where you're distributing an asset only, or is it actually a combination? And we'll need to know that. Once we know that information, you're going to give us the details. You're going to let us know the specific amount that you want distributed. You're going to let us know, is this a one-time distribution? Is it a recurring distribution? And then, of course, we need to know, well, how would you like the distribution sent to you? This obviously applies to a cash distribution. And if you're doing an in-kind distribution, you need to let us know which asset are you taking the distribution from. You're going to let us know if it's a partial distribution or a full distribution. In other words, you're moving the entire asset out of the IRA into your personal name. But this is how you start. You get this filled out. There is going to be some tax withholding. Now, keep in mind that we'll ask you if you would like to withhold tax from your distribution. This only applies to cash distributions. So as an example, if you're doing a distribution of precious metals and there's no actual cash to withhold, we can't do a cash withholding for a physical asset. So hopefully that makes sense, but you're going to let us know if you want any federal or state income tax withheld. Finally, let us know how you'd like to pay for this transaction, and then sign. And that's basically how the process gets going. You fill out this distribution and notice of withholding form. Okay, so commonly asked question, how long do RMDs continue? Well, it continues for your lifetime until all eligible accounts are depleted, meaning you've drawn the balance down to zero. Well, what happens if you don't deplete your accounts in your lifetime? Well, that means that your beneficiaries will inherit those accounts. And when those beneficiaries inherit the account, most of those individuals must deplete those accounts within 10 years. The exception to that would be if a spouse inherits a retirement account. Okay, how do I calculate my RMDs? Well, I always say you can do a search on your internet, Google required minimum distributions plus IRS, and the IRS has information there and worksheets that help you calculate your required minimum distribution. Remember, when you go to our website, the required minimum distribution page, there is a calculator there. Your CPA can help you. So to be very clear, here at New Direction Trust, we can provide tools to help you determine what that required distribution is, but we will not actually calculate it for you. And here's the reason we don't do that. We don't know if we have all the information to accurately give you a required distribution amount. So if we don't get all the necessary data, we don't want to share a number that unfortunately may not be accurate. And so this is why we always suggest you lean on somebody to kind of double check the number that you're coming to, just to make sure that it does work. So this is a common question that comes up, and that is, what if I own more than one retirement account? That's actually very common these days. And so there are some basic rules about how you calculate a required distribution. And let's start with IRAs. If you have more than one IRA, basically what you do is you add up the value of those accounts, and you always do the calculation based on the December 31st balance of the previous year. When you add up all those accounts, the IRS doesn't care where the distribution comes from, but whatever that number is, you need to take it out of at least one IRA. You can take it out of multiple IRAs, but you can put all the IRAs together and do what we call congregate, and you're going to calculate one number from those IRAs. Well, what happens if you have an employer type retirement plan? This is where it gets a little bit different, a little bit more involved. Let's say you have a 401k or something along the line of a simple IRA or a SEP IRA. these are employer type retirement plans. So the required distributions are calculated separately. So if you have a 401k, for example, you're going to have a required minimum distribution for just that 401k, and it has to come out of that 401k. You can't dip into another IRA to satisfy that required distribution. So those are standalone. You can't involve other IRAs in that distribution. 403Bs are a little bit interesting. The distribution can be calculated from the separate accounts, and this is the one exception with employer plans where if for whatever reason you had more than one 403B, you can put those 403Bs together, take one distribution from one of the accounts. But again, this would be separate from an IRA as an example. So the 403B would have its own separate required distribution. So what happens if I forget to take a distribution? The IRS recently has imposed a 25% tax on the amount that should have been distributed. And how do they know? Keep in mind that IRA custodians report the values of those accounts to the IRS just like a 401k or 403B provider would. So the IRS knows how old you are. They know when those required distributions are due. And so you'll probably get a notice in the mail if you missed your required distribution. So very quickly, I want to talk and mention again Roth IRAs and also Roth type accounts. So just know that anything that's a Roth account is not subject to required distributions. So if you have a Roth IRA, a Roth 401k, anything that's a Roth, you don't need to use that in the calculation for required minimum distributions. In fact, they are never required. So if you want to, you can just keep that account, and when you pass away, that goes to your heirs, and they'll have a tax-free account to distribute from. Now, here's what's important to know. When a non-spouse inherits one of these Roth type accounts, they will have a 10-year distribution. If a spouse inherits that account, they can choose to accept that account as their own, and when they do that, they are not subject to required minimum distributions. Okay, so we've talked about required distributions when you reach RMD age. Now let's talk about an inherited IRA. So with an inherited IRA, an inherited account, if a spouse inherits some type of a qualified retirement plan, it will always become an IRA, and the spouse can do something that no one else can do, and that is they can treat it as their own. So what happens is the original owner of the account, that whatever assets are in there go to the spouse. It literally just goes in the spouse's name. It's associated with their Social Security rules. So once that inherited IRA is in their name, all the normal rules apply to them just like it would have to the original owner. Now, if a non-spouse inherits an IRA, then there is a 10-year distribution. Wanted to talk just briefly about a little bit of confusion and some clarification around these inherited IRAs. So because there was some confusion and we were in the midst of COVID, the IRS did something unique, and that is that if somebody passed away from 2020 up through even 2024, they actually waived required distributions from inherited IRAs, not for people who are of required minimum distribution age. And it was because of confusion about the new rules. What's important to know is that beginning in 2025, the IRS has made it very clear that if you have inherited an IRA and you are not a spouse, you may be required to take those distributions starting in 2025 and moving forward. Now, it is important to note that there are some situations where if somebody inherits an IRA, they may not have this 10-year distribution period. So an example, just some examples are if a minor child, someone younger than the age of 18, inherits an IRA, if an individual is disabled or chronically ill, or they're more than 10 years younger, they may have a slightly different distribution schedule than the 10-year distribution schedule. This is where I would involve a CPA, get a little help if you have a situation like that. So with an inherited IRA, the question becomes, do I have to take an RMD everywhere? And this is where the IRS makes it confusing, but the answer is maybe. Why is it maybe? Because we have to look at the individual that passed away, and there's a pretty simple rule to remember. If the individual that passed away has already started RMDs, then they continue, and they must continue every year. So the idea here is that once RMDs are switched on, they stay on. So if the individual that passed away has already been taking required distributions, whoever inherits that account, they will also every year have to take a required distribution. And by the end of the 10th year, that account does need to be emptied. So what happens if somebody has not started their required minimum distributions? They're younger than that required minimum distribution age. When somebody inherits an IRA, in that scenario, the only requirement is that they empty the account within 10 years. They do not have to take annual required distributions. They can take it every other year. They could take it all at the end in the 10th year. And again, if you're in that situation, I would say check with your CPA. If you take all the distribution in 1 year, there could be a tax burden there. But just know we could look to the person that passed away to determine whether an every year distribution is required. So with inherited IRAs, the question becomes, well, how do I calculate if I need to take a required distribution? How do I calculate that? What I would say is that for most individuals, you're going to want to go to the IRS and look for the single life expectancy table. Now, again, there are some exceptions, but the single life expectancy table, basically what that means is when you take over that account, you sort of step into the shoes of the person that had already started those required distributions. And we're going to take a look at your age to determine when those distributions need to happen. Here, I would definitely seek some tax advice to calculate this kind of a required distribution. So I want to talk a little bit about some different ways to take a required distribution. So we had talked about taking a cash distribution and also an in-kind distribution, but there is something called a qualified charitable distribution. You'll sometimes hear that called a QCD. And you can donate to a charitable organization. That organization must be a 501c3, and they have to have that designation. And you can make up to as much as your personal required distribution amount, or even up to 100,000, whichever is larger. And this does count towards your required minimum distribution. And again, this is a donation. It's a donation to a charitable organization. So it could be a church, any kind of a nonprofit organization that you believe in. And so I guess the reason you might consider this is that by making this contribution to a charity, the charity, of course, is a tax-exempt organization. So as an example, if you were to donate, let's call it $25,000 to that organization, the full $25,000 can be used by that organization, and they are not taxed on it. Whereas if you took the distribution, obviously there's a tax that's probably most likely going to be due unless you happen to be in a zero tax bracket. but it's just a way to take care of the required minimum distribution, and if you're charitably inclined, something that you can certainly do. There is something also called a still working exception, and the bottom line is this: if you are working and you've reached RMD age and you have an employer plan that offers what's called the still working exemption, while you're working for that organization, you're not required to take an RMD. But you must be employed, and the employer must offer this still working exemption. It's usually part of their retirement plan, so it might be a 401k, a 403b, or something like that. And so if you happen to be in that situation, it's a way of delaying required minimum distributions. And one thing that you could do to kind of avoid some other additional distributions is, if you have an IRA, it is possible to roll that IRA into the employer plan, and by doing that, that IRA would be delayed from taking that required minimum distribution. All right, so we've covered some basic information related to required minimum distributions. And so the question is, well, what happens if I have questions? Where can I get some more help? If you're a client of New Direction Trust, we have a couple of ways that you can contact us and get some assistance. One is by logging into your account and using the secure portal messaging system. Go in, simply type your message, and within 2 to 3 business days, someone on our client services team will respond and answer that question. The other way, if you prefer to talk to a live person, is to give us a call at 877-742-1270, and when you select option number 4, that'll take you to the first available client representative. So I hope you got some good information about required minimum distributions, and I hope you have a great day. Take care.